My friend David sold his tech stocks at the peak, March 2020, right before everything crashed. Everyone called him lucky, genius timing, perfect exit. But here's what nobody knew. He wasn't lucky. He was following a rule his grandfather taught him. A rule that has nothing to do with market timing, technical analysis, or insider information. A rule so simple it sounds stupid when you first hear it. He said, "When everyone's celebrating, I get nervous. When everyone's panicking, I get interested." That's it. That's the whole thing. And it's made his family wealthy for 3 generations. Not because they're smarter, because they see markets differently. They see investments differently. They see risk itself differently. There's this investment strategy used by Jewish families that most people completely miss. Not because it's hidden, because it's counterintuitive. It goes against everything modern finance teaches, everything social media promotes, everything get-rich-quick culture promises, and yet it works, consistently, across decades, across market cycles, across economic disasters. It's not sexy. It won't make you a millionaire overnight, but it will protect you from becoming poor, and over time, that protection compounds into serious wealth. Today I'm revealing this strategy, not the surface-level stuff, the deep principle that drives how Jewish investors think about putting money to work. It's going to challenge everything you believe about investing. It's going to feel wrong at first, but once you see it, once you understand why it works, you can't unsee it, and your investing will never be the same. But first, I need to know where you're watching from. Drop your city in the comments right now. Are you in Miami, Toronto, Amsterdam, Singapore, Cape Town? I want to see how far this community reaches, because this investment principle works everywhere, in every market, in every economy. Type your city below. Let's build this global conversation. All right, here's the strategy that 90% of people miss. It's called inverse consensus investing, but that's a fancy term for something simple. When the crowd goes one direction, you look the other way. Not automatically, not blindly, but carefully, skeptically, with extreme attention. Because crowds are almost always wrong at extremes. When everyone thinks something is the best investment ever, it's probably overpriced. When everyone thinks something is worthless, it might be undervalued. This isn't contrarianism for the sake of being different. It's pattern recognition built from centuries of survival. Jewish families learned this the hard way. When everyone said land was the safest investment, Jews couldn't own land and had to find alternatives. When everyone rushed into certain industries, Jews were excluded and had to innovate elsewhere. When everyone believed the economy was stable, Jewish communities remembered it could collapse overnight. So they developed this instinct, this radar for when consensus becomes dangerous. And that radar, that ability to step back when everyone's rushing forward, it creates opportunity. Let me give you a concrete example. 2008 financial crisis. Housing market destroyed. Banks failing. Everyone terrified of real estate. The consensus was clear. Stay away from property. It's toxic. It'll take decades to recover. And that's exactly when Jewish investors I knew started buying. Not recklessly, carefully, selectively, but they were buying when everyone else was selling. Why? Because the consensus had swung too far. Fear had created opportunity, and they had the discipline to act when it felt most uncomfortable. This strategy requires something most investors don't have: emotional control. Because going against consensus feels terrible. Your brain screams you're making a mistake. Your friends think you're crazy. The news confirms you're wrong. But Jewish investors have this generational wisdom that says crowds panic, crowds get greedy, and both emotions destroy wealth. So when you feel the crowd's emotion, you pause, you question, you look for what everyone's missing. Here's the second part of this strategy that people miss. It's not just about going against the crowd. It's about patience, extreme patience. Because when you invest against consensus, you're early, sometimes very early. The market doesn't prove you right immediately. Sometimes it proves you wrong first. Prices drop more. Fear intensifies. And this is where most people break. They can't handle being early. They can't handle looking stupid for months or even years. But Jewish investors expect this. They build it into the strategy. My uncle bought gold in the late 1990s. Everyone mocked him. Gold was dead. Tech stocks were the future. Why own shiny rocks when you could own Amazon? And for years, he looked foolish. Gold went nowhere. Tech exploded. But he held. Why? Because his thesis wasn't about next quarter. It was about next decade. He understood that when consensus becomes extreme, when everyone believes the same thing, reversal is inevitable. not next month, but eventually. And eventually came. Gold rallied for a decade. Tech crashed. His patience paid off. This is what 90% of investors miss. They want to be right immediately. They need validation now. They can't stomach looking wrong. But inverse consensus investing requires you to be comfortable being early, being wrong temporarily, being alone in your conviction. That's the emotional cost, and most people can't pay it. Third element of this strategy. It's not about timing, it's about positioning. Jewish investors don't try to catch exact bottoms or tops. They position themselves in ranges. When assets get cheap relative to history, relative to fundamentals, relative to value, they start building positions. Small at first, larger as prices drop more. They're not calling the bottom, they're buying value. And when assets get expensive, when everyone's euphoric, they start reducing. Not market timing. Risk management. I watched this during crypto boom. Bitcoin at 60,000. Everyone buying. Everyone convinced it's going to 1 million. The consensus was deafening. And Jewish investors I knew were selling. Not because they thought crypto was worthless, because the crowd had become too confident, too certain, too leveraged. And when crowds get that confident, bad things happen. They didn't call the top perfectly. They sold on the way up. They left money on the table. But they protected their capital. And when crypto crashed, they still had powder dry to buy back lower. This positioning mindset removes the pressure of perfect timing. You're not trying to be perfectly right. You're trying to be approximately right with margin for error. You're building positions when things are hated, reducing when they're loved. That's it. Simple. Not easy, but simple. Fourth aspect people miss. This strategy requires detachment from social proof. You can't care what other people think. You can't need validation from the crowd. You can't measure success by whether your friends approve of your investments. Because if you're doing inverse consensus correctly, you'll look wrong most of the time. The crowd will think you're stupid, and you have to be okay with that. Jewish culture actually supports this. There's less emphasis on showing off investments, less posting about wins, less need to prove you're smart. Your portfolio is private. Your decisions are yours. And that privacy protects you from social pressure, from the need to follow trends because everyone else is, from the fear of looking different. When you detach from social proof, you can think independently. And independent thinking is the foundation of inverse consensus investing. Let me give you the final piece that ties this together. This strategy only works with one thing: knowledge. You can't go against consensus blindly. You need to understand what you're investing in, why the crowd is wrong, what they're missing, what could change. Jewish investors study obsessively before acting. They read, they research, they ask questions, they understand the fundamentals, because you can't be confidently contrarian without deep knowledge. Otherwise, you're just gambling. So here's what inverse consensus investing actually looks like. The crowd loves something, you study it, and look for risks they're ignoring. The crowd hates something, you study it, and look for value they're missing. You move slowly, you position over time, you ignore social pressure, you stay patient. You prioritize being approximately right over perfectly right, and you accept that you'll look wrong before you're proven right. This strategy won't make you rich quick, but it will keep you from going broke. And over decades, avoiding major losses while capturing occasional wins, that compounds into serious wealth. That's the strategy 90% miss. Not because it's complicated, because it requires emotional discipline most people don't have. Now tell me in the comments, have you ever invested against the crowd? How did it feel? What happened? Share your story because this community learns from real experiences. I read every comment and respond to as many as possible. Drop it now. Be specific about what you bought when everyone said don't, or what you sold when everyone said hold. Hit that like button because this content reaches people who need to hear it. People about to make emotional investment decisions. People following crowds into bad positions. Your engagement matters. Subscribe because next video explores something even more controversial. A Jewish wealth principle that sounds selfish, but is actually the opposite. It challenges everything about giving, receiving, and building community wealth. You won't want to miss it.